If you think canceling debts worth over $20 billion is no big deal, then think again. Today's news headline involves none other than the president of Russia himself, Vladimir Putin. That's right, Putin has made a game-changing decision that has caught the attention of the entire world. In a historic move, Putin has canceled Africa's debts worth over $20 billion. It's a bold move that is set to have a significant impact on the African continent, and we're here to discuss it all. But please remember to like and share this video, and also subscribe to this channel. So without further ado, let's dive into the details and see how Putin's decision is going to change the game. Putin cancels Africa's debts, totaling more than $20 billion. In recent decades, Russia's influence in Africa has expanded dramatically. Many African countries have signed bilateral trade treaties with Russia, and diplomatic and military cooperation links have strengthened. Economic cooperation between Russia and the continent has resulted in many countries owing Russia money. Russia has emerged as an important ally for many African governments, and Putin has made great progress towards strengthening ties between the two regions. At the Russian Africa in the Multipolar World Conference, Putin reaffirmed Russia's commitment to prioritize cooperation with African nations. The elimination of African loans is only one of the audacious moves Russia has taken in recent years to forge a more productive and mutually beneficial relationship with the continent. This debt arose from Moscow's contacts with African governments that supported its communist ideology, or from which Russia had previously attempted to collect. At the time, Russia supported several countries, including Angola, Algeria, the Democratic Republic of the Congo, Ethiopia, Namibia, Mozambique, Morocco, and South Africa. As a result, many African countries discovered that they were deeply in debt to Russia, with official records putting the total debt at $20 billion. During the conference, Putin also revealed that trade between Russia and African countries is expanding, with the volume of trade expected to reach an eye-popping $18 billion by 2022 and continue to rise. Furthermore, Putin indicated his belief that a more stable shift to national currencies and financial settlements, as well as the construction of new transportation and logistics networks, will help the development of reciprocal economic exchanges. By taking these actions, Russia and African countries will most likely be able to establish stronger and more self-sufficient economies, paving the way for a more prosperous future. He stated that the process of establishing the African Continental Free Trade Area, which began in 2021 and would become a traditional market with a total GDP of more than $3 trillion, has created more opportunities. During the discussion, Moscow also stated that it supports bilateral and Eurasian Economic Union-mediated connections with the African Continental Free Trade Area. He went on to say that Africa is poised to take the lead in the multipolar world. We are convinced that Africa will become one of the leaders in the emerging new multipolar world order, he says. Africa's weight and importance in world affairs are growing all the time. They are increasingly exerting themselves in politics and the economy. This is far from the limit, but such a figure is unlikely to completely satisfy us, he continued. Putin stated that a more aggressive shift in financial settlements to national currencies, as well as the establishment of new transport and logistics chains, will contribute to the growth of counter-commodity exchanges. The move on Crimea, which has won Moscow global condemnation, and the possibility of Western sanctions, will be a blow to an already fragile economy, with U.S. Secretary of State John Kerry vowing very serious repercussions. And perhaps more importantly, it will exacerbate investor suspicion of Russian institutions. According to Gary Greenberg, head of emerging markets at Hermes Fund Managers, if uncertainty persists, a sell-off in Russian financial markets could accelerate, particularly in equities, where foreigners are estimated to hold 70% of the market. The market believes that the Russian government is willing to sacrifice both the country's economy and its international standing to bolster its pretensions for a Eurasian Union. Greenberg said, referring to Moscow's aim for an ex-Soviet customs union. On the surface, this appears to be very bad news, and it raises concerns about the case for investing in Russia, he said. It also appears to me that the economy will deteriorate from here, so some kind of sell-off is appropriate. Moscow stocks have suffered the greatest massacre yet, with a 12% drop on Monday wiping out about $60 billion from the market's worth. The ruble has hit new lows, forcing the central bank to increase interest rates by 1.5 percentage points. According to traders, it sold $10 billion in foreign exchange markets. Even Russian sovereign dollar bonds, which are the most widely traded emerging debt securities, have dropped off, with their average yield premium to U.S. Treasury bonds increasing 2.6 percentage points on the day. Losses will rise if Western countries impose economic restrictions on Moscow. As potential actions, Kerry has suggested asset freezes, travel bans, and trade isolation. Whatever the conclusion of the situation, Russia stands to suffer the most, according to Francesc Balcells, fund manager at PIMCO. Restriction on keeping Russian financial assets, for example, may make life difficult for enterprises that rely on foreign money for loan and equity financing. Companies are now facing higher borrowing rates and loan delays worth billions of dollars as foreign banks become wary about lending. Russian corporates are among the most active in international debt markets, and Russia has worked hard to open up its local currency debt market to foreign investors while improving the investment climate, said Balcells. A clash with the West would erode many of these achievements, driving away even more foreign investors. How does timing affect this incident? Because of the timing, the moods are even more lethal. First, Russia's economy is in peril, with GDP dropping to less than 2%. Inflation rising, and investment levels stagnant at approximately 20%, far below necessary levels. The outlook for oil, which accounts for half of the budget income, is bleak. Second, over the last 2 years, investors have overcome their Russia worries and piled into ruble bonds, where they now own over a quarter of the market. According to central bank figures, they had increased their holdings to 900 billion rubles, $25 billion, by the end of 2013, a ninefold rise from early 2012. Despite the turmoil in developing markets, they have maintained their positions, assuming that Russia's reserves will keep the ruble stable. Instead, the ruble has been one of the worst-performing emerging currencies this year, falling 10% against the USD. That surprise currency collapse may fuel an exodus of foreigners who had not budgeted for the losses, but the exit may have begun before the new developments. According to J.P. Morgan's monthly investor survey, funds were underweight on the ruble and local bonds in February, while dollar debt positions were also significantly reduced. I guess that markets will look for more risk premium in Russia, said Sam Finkelstein, a Goldman Sachs asset management bond fund manager who is impartial on Russia. It may be more difficult to persuade equity investors to stay. Morgan Stanley predicts that over $2 billion has exited Russian stock funds this year, following $4.2 billion in withdrawals in 2013. Russian stocks trade at roughly 4.7 times their expected 2015 earnings, the lowest among emerging markets, due in part to corporate governance concerns and a lack of trust in local institutions. Shares in another unstable emerging economy, Turkey, trade at more than 7 times earnings. Some funds, such as J.P. Morgan, believe shares are cheap enough to invest in, while others, like Greenberg, are content to wait, fearing an economic downturn or perhaps a full-fledged conflict. Others may simply opt to cut and run. According to Christopher Granville, a long-term Russia observer and managing director of consultancy Trusted Sources, the Kremlin would have to work hard to entice investors back. He sees comparisons to the Yukos affair of 2003, when Putin seized Russia's largest oil business and imprisoned its owner, Mikhail Khodorkovsky, on corruption charges, causing a widespread exodus of foreign investors. At the time, Putin decided that he had an agenda that he was going to pursue regardless of the cost to the economy and investment climate, and there were certainly high costs. Granville explained. This time, he's decided that Ukraine is of paramount importance, and he's going to take it on the chin. Russian assets may recover if the damage is contained. Alternatively, Putin has crossed a chasm, and in that scenario, Russia will be uninvestable in the foreseeable future. Despite being a global outcast with an arrest warrant hanging over his head, he has persisted in his pursuit of tighter ties with Africa. His unwavering commitment to the continent stems from his belief that the continent's economy has vast untapped potential. He is determined to do all possible to ensure that both Russia and Africa enjoy a successful future. What do you think about Russia wiping out all of Africa's debts? What steps do you expect the US to take to retake Africa from Russia? Let us know in the comment section. Don't forget to like, share, and subscribe to this channel. Thanks for watching.